Let's generalize the formula for weighted average cost of capital. This is for can be applied to a firm with any number of capital structure items. So basically, again, it's just a weighted average where suppose you have a firm with a number of different types of common equity, a number of different kinds of classes, number of different kinds of classes of preferred equity, which are the P's there, and then a bunch of different types of debt, maybe 5-year bonds, 10-year bonds, 20-year bonds. Just take a weighted average. Figure out the market value of each form of common equity, the market value of each form of preferred equity, the market value of each of the different kinds of debt, and go ahead and add them all up to get V, which is the market value of the firm, the market value of the firm's assets, the market value of the firm's capital structure. And that lets you come up with the weights of the costs of capital. And remember, those costs of capital are the expected return. So E1, that first type of common equity, shareholders hold E1 is how much they totally hold. As a share of the whole capital structure, it's E1 over V. And that's the cost associated with it. That's the cost associated with each of these types of equities. Same with debt. And remember, because of the tax deductibility associated with debt, we want the after-tax costs, so we put in 1 minus the tax rate. So again, there's a lot going on with this formula, but hopefully it's easy to see how all it is a weighted average, where the weights are based on the market values of all of the particular item that is held by investors, and the costs are the expected returns, making sure that when you're dealing with debt, which in our case will be bonds, you take into account the tax deductibility. So let's take a look at an example. Busker Corp, 10,000 5-year bonds, priced at 1,000, expected return of 5%. Company has 1,000,000 shares of Class A common stock, which is priced at $20 each, and an expected return of 20%. 2,000,000 shares of Class B common stock, priced at $15 each, with an expected return of 15%. 10-year bonds, there's 12,500 of those outstanding, and they're each priced at 800. Expected return on there is 10%. And finally, 3,000,000 shares of preferred stock, priced at $10 per share, with an expected return of 12%, and the corporate tax rate is 40%. So this is set up pretty straightforward. You've got bonds, so here you have to take into account taxes. Stock you don't, stock you don't, bonds you do, and preferred stock you don't. So you've got two kinds of common, one kind of preferred, and two kinds of bonds. So in order to get the WACC, it's simply a weighted average. You've got E1, which that's what we'll call our Class A. E2, it's our Class B common. Preferred, D1, which is what we'll use to refer to our 5-year bonds, and D2, our 10-year bonds. Let's go and figure out the value of our holdings of each of these five, add them up so we can get our weights. We got our costs. We've already established that the bonds are the ones that we need to take taxes into account, and do a little bit of arithmetic. So Class A common, there's 1,000,000 shares of 20, so we have 20,000,000 of it with an expected return of 20%. Class B, 2,000,000 times 15 is 30,000,000, expected return of 15. Preferred, 3,000,000 at 10, which is also 30,000,000 with a expected return of 12. D1, which is our 5-year bonds, there's 10,000 of those, priced at 1,000, so that's 10,000,000, expected return of 5%. D2, you've got more of them, but they're only priced at 800, so if you owned all of them, you'd have $10,000,000 worth of bonds, 10%. Total value of the firm's assets, $100,000,000. So now just do a weighted average of the capital structure. 20 million of the 100 million in the whole capital structure is in the form of equity, or of the $100 million held by investors, 20 million is held by Class A common shareholders, and the cost to the firm, the expected return for them is 20%. 30 million is held by the Class B shareholders, 30 of the 100, and they have an expected return of 15, so that's a cost to the firm. You can view it as 30 of the 100 is in the preferred stock. Those investors require 12%. 10 million is held by the investor, or there's $10 million worth of bonds that mature in 5 years, so 10 of the 100 million is in these 5-year bonds, which has a yield to maturity of 5, but it doesn't actually cost the firm 5 because they pay out 5. It lowers their taxable income by 5, so it actually costs them 3. And then finally 10 out of 100 in the longest term bonds, ones that mature in 10 years, which have a yield to maturity of 10, but again, to the tax deductibility doesn't cost them 10. Just do the arithmetic, and the weighted average cost of capital for this firm is 13%. What does it mean? Look at all the things that we have learned. We've done more than just a bunch of math. We've learned, first of all, that the assets of the company are worth 100 million. We've learned that those assets have an expected return of 13%. We learned that the assets have the same level of risk as stocks and bonds that have expected returns of 13%. And finally, we've learned that these assets, which are worth 100 and have an expected return of 13%, the assets are expected to produce enough to have enough of a return such that the holders of the common A equity, they hold 20 million, can expect a return of 20. The 30 million that hold Class B common equity can expect 15. The 30 million that's held in by preferred shareholders, they can expect 12%. The 10 million, the bondholders that hold those 10 million of the 5-year bonds can expect 5%, and the 10 million that hold the 10-year bonds can expect 10%. That's what it means. So it's more than just number crunching. We've learned quite a bit about the assets and the return and the risk, and then this is what that all means.